Alrighty, I am back, guys. It has been, let me fix my camera here. So it's been about a week since I've seen you guys. I went on a vacation this past week to celebrate my wife's 30th birthday party. We went to 30A, Florida. So it's basically in between like Destin, Florida and Panama City, Florida. And it's like this little strip. Absolutely beautiful. If any of you guys have family, specifically like if you're a husband or if your wife and if you have kids or whatever it might end up being, 10 out of 10 recommend that vacation location. That's 38 Florida. We went to Rosemary Beach. I mean, it was absolutely beautiful. So, but we're back. I just ended up coming back in late last night at about 11 o'clock, and then now it's about time to get back to work. A lot of things ended up happening this last week. So there was a couple things. So I did manage to follow along with the markets during this entire week last week. But there was a couple big catalysts that I ended up noticing, and a lot more things happened last week that I think that people really made out to believe. I mean, obviously, Elon Musk ended up releasing this, like the Robotaxi announcement, and we'll talk about that. But I also think that the macroeconomic data and what's going on with the bond market is really important to pay attention to, and not only just the bond market, but also how the other sectors are moving right now. So I'm thinking that there's actually quite a bit, like we are in the conditions that would favor a correction of some sort. I don't know if it's a market crash. I don't think it's going to be a market crash, more or less because I think that what we're seeing from, like, what I'm seeing from a valuation perspective is that elevated valuations. So like there's a couple different things that we need if we're actually going to crash, right? So I think to myself, like, if we're really going to have a severe or devastating market crash, I usually think about higher valuations, um, euphoria, because higher valuations and euphoria and detachment of the fundamentals, or detachment of the stock prices from the fundamentals to the upside, is a huge proponent. So like if things are very over, like, sorry guys, I got weekend brain. So if I'm stumbling and fumbling, this is live. I haven't talked stocks for about a week now. So 2 weeks actually. But if you see stock prices actually elevated and detached to the upside, this creates the conditions necessary for actually like a stock market crash, coupled with a couple other things, right? From like macroeconomic data and whatever might end up being. But what I'm seeing here is that right now stock prices are actually really low, X Mag 7. So this is a very unusual market that we've had. And I'll even show my Savvy Trader to show you guys what I'm seeing. From like an overall like stock market performance on a year-to-date basis, stocks have performed extremely well. So like we look at the other sectors, XLI, so the industrials, they performed really well. We think about the consumer staples, XLP, they performed really well. XLE is performing, that's actually the leading sector this year, performing extremely well. And we'll talk about that in just a minute. And even gold is breaking out too. But these are actually, from my perspective, warning signs, because I'm not necessarily seeing a lot of the other stocks that are out there, like Lululemon, that are reporting earnings, and they absolutely got whacked, right? But this is a consumer facing stock. What I'm seeing is that a lot of companies are guiding down their full year guidance. And this happened with a lot of the companies that I own as well. And not only that, but Tesla's Q1 delivery numbers were absolutely abysmal. But it wasn't just Tesla, it's basically every EV manufacturer out there. So what we're seeing is, like, from a company perspective, data isn't that strong. Like, and this is especially the consumer facing companies. I think even McDonald's is starting to say that they see weakness. And this is stuff that we need to take note of, because like these are otherwise known as quote unquote recession proof companies. So when we see recession proof companies actually starting to say that there's consumer weakness, this actually does start to concern me, right? Because they're the boots on the ground, they're seeing the data. But anyway, what we should be paying attention to here is a couple big macro releases that we ended up having, not only last week, but this week. We should really start rolling on into a lot of the things that we got we got a lot to talk about, guys. We got a lot to talk about. All right. So let's start with like Elon Musk's Tesla Robotaxi. I want to get this one out of the way first. I think that this has been a lot on investors' minds. And I think what I actually want to do is talk about not necessarily like what my takeaway is, right? But I'm going to explain basically what this means for the business model. So I think that one thing I ended up reading here over the weekend as well is Elon Musk ended up actually releasing this in 2016, but he retweeted it. I don't know what you want to consider. He ended up releasing it again and saying like, hey, this still applies. So what does this mean essentially? What he's basically talking about is he's basically giving, and I fully recommend checking out his Twitter and going back and actually reading this, and I retweeted it too. And what he essentially talks about is like his plans, his step-by-step process, and what he's planning on doing. And one thing that I wanted to talk about in particular was actually the autonomy portion. So when he ended up releasing recently about talking about his autonomy, like his autonomy plans and his autonomy goals, from like a Robotaxi perspective. So it's like, think about it like this: Tesla is a car company, and any bold that says that it's not a car company, I usually say that it's AI and robotics because that's where it's going, right? So when you think about like what you're buying, when you're buying a company, it's not just about like what they have done and what they're doing. So like Apple, I don't like Apple. I don't like Apple as an investment because I don't know where they're going. So like Tesla, for example, like they have been a car company, they are a car company today, but like where are they going? So when they're talking about actually licensing out a lot of their FSD functionality, because 12.3.3 right now is what the FSD version it is right now. This is eventually, so like Elon Musk coming out and saying Robotaxi release on 8.8. What this essentially tells me is that they are making monumental progress extremely fast. So now what I'm thinking of is that this is actually going to be an evolution in the business model and an overarching change in the overall thesis of what Tesla is actually going to end up being. So what I'm talking about, like the change in the thesis, is that when he basically creates a software-like revenue stream, which is going to be FSD, and also license this out to every single other car out on the road. Now, for the other manufacturers, right? So like Ford could essentially buy FSD from Tesla or license FSD from Tesla. So now what Tesla ends up becoming is they become like a central hub to this basically artificial intelligence software, right? This is the next evolution of what AI is going to become. Like we need to know exactly who the major providers are going to be, the major winners are going to be from the software side, right? So we know that data, like right now we have the data build out. That's NVIDIA, AMD, basically a lot of the GPUs or like SMCI, Dell computers. Like this is the data infrastructure component. The next evolution of AI is going to be the application or the software component of AI and like how to actually commoditize or release a product down to the end consumer or to like businesses, whatever it might end up being. And then this is essentially that next step. And I think that Tesla, from my perspective, is the only one that actually has a usable application that can be scaled out on a wide to a lot of different customers and a lot of different consumers, because they also have Teslas out on the road. And then keep in mind with the licensing, whatever it might end up being, this is definitely something to pay attention to. So that's essentially what I ended up seeing from that. And then also when we're thinking about like the stock price, like the short-term stock price, I think that people are trying to short Tesla right now, and it's stupid. Like when you actually look at the stock price, it's trading on structural support that's been going back since, what is that, October of 2022. So you can see that Tesla's been basing out in this zone for a long period of time. You also see a positive divergence on the daily RSI and the daily MACD. So it's like I'm seeing people shorting Tesla at $175 per share or whatever it might end up being, $180 per share, and it's like, dude, you got to see the positive divergence right here, and you got to know that's on structural support. There's basically a lot of buyers stepping into this area right now. Plus, the thesis is getting stronger towards that FSD. I mean, I could see Tesla actually being one of the bigger winners at the back half of this year. All right, enough of Tesla. What I wanted to actually talk about is I wanted to talk about a lot of the jobs data that ended up coming out. So this is on Friday. So I thought that this was actually a really, really big release. This actually goes hand in hand with a lot of what I'm seeing here. So like over the past, it's important to rehash what's happened over the past couple months. So January, February, and March. What's essentially ended up happening is we've seen stronger data on the inflation and the jobs front, month after month after month after month. Right now it's April. So we've seen in March, and so January and February's jobs data was hotter than expected, and now March is too. And when you think about like, and this is actually reflecting in the markets and how the sectors are trading too. So the jobs market is still tight. It's still imbalanced, and that was something that's really concerning to me actually. And the reason why it's concerning to me too, actually, I'm on StreamYard. So all right, the reason why this is concerning to me is that after this jobs data was released, so June is actually not favored to have a rate cut. So before the jobs report, and you guys can actually see that right here. So before the jobs report, this is 1 week ago, you can see that there's a 55% chance that we were going to get a rate cut and about a 39.6% chance that we were going to get a pause. And now after the jobs release, we got a 46.1% chance of a rate cut and a 51% chance that we're actually going to pause, right? And it really concerns me that now that the yield curve is actually moving out. So what this is essentially saying that they're basically saying higher for longer. So you can even see that this is a month ago. So this is basically predictions for the July meeting. And you can see that from right here, it was about a 9.3%. This is a month ago, 9.3% chance that we were actually going to stay as we were at 5.25 to 5 point, it's basically like 5.35 at the midpoint. To now, it's slowly starting to become favored. Where we're actually where the markets are starting to think, hey, this inflation thing is a lot stickier than what I anticipated. What's even more concerning is that not only is the bond market sniffing out that inflation is stickier than expected, but we also have CPI coming out this next week, which I do think is going to act as a major catalyst, and we can actually see that in this economic calendar that we have. So it's actually going to come out on Wednesday. So I got to make sure that I'm sharing my screen here. All right, so it's actually going to come out on Wednesday, and we can see that the CPI data is going to come out, and it's supposed to come out at about a 0.3. So core CPI is about to be about 0.3. Headline is supposed to be about 0.3. That's month over month. So it's still expected to show, gosh, I don't even want to do that in my head right now. Annualized, I think that's somewhere, let's actually do that math real quick. So 0.3 times 12, that's 3.6%. Is basically what that ends up being annualized on both the core CPI and the headline CPI. And that's a little bit higher than what it is currently right now from like a top line perspective. So you can actually see that like right now, it's currently, so headline CPI is expected to be about 3.5% from the previous of 3.2%, and core CPI, once again, it seems like it's about stable. So this is actually really concerning. And this is actually being reflected a lot in the energy market too. So when we're thinking about why this is so important, so like when we go back to the sectors and how sectors are reacting to this. So like this is a huge reason why I think that if I'm losing you guys, I think my computer's kind of freezing up right now. So when we think about like how the sectors are moving, like what's the stock market telling us? So not only are we getting these economic data points rolling in right now, like the economic data points are basically saying that everything is a lot hotter than expected. And even the anticipated CPI is an acceleration from where we had it before. Remember that 3.2% on the headline CPI to 3.5%. Now, I'm not usually the type to extrapolate small data points and say like, oh my gosh, the world is ending. That's not how I roll. But what I do usually pay attention to is I do try to pay attention to the overall trend and like what it means in the macroeconomic cycle. And right now, I think the market, so like when we do a little intermarket analysis, it's actually reflecting to us right now about what we could potentially see over the coming weeks/months, or even over the course of this quarter and quarter two. I think that currently today, I think that we're running a very high risk of actually seeing some sort of stock market correction or some sort of downward movement, particularly in large cap stocks. So I thought so I pulled up two of these different charts. So we can see that right now that usually when you start seeing a stock market cycle top out, we see two different sectors perform really well: energy, and we see precious metals. So when we actually go to the charts and we look at like which company, or not which companies, which sectors are performing the best right now, we can see that energy, so XLE, and this is a weekly chart. This doesn't reflect the full, like how good energy has been this year. So this bar right here actually shows that energy has been straight up to the right for the better half of 2024, and it has been the best performing sector, and it did break out from recent consolidation, which is something to be aware of and something to be concerned of. And then we also had the similar price action here with gold. Now, there's two different asset classes that perform extremely well, especially when we're thinking about like inflation and the topping of the overall market cycle, and why these commodities, let's call them, why these commodities actually start to accelerate at the back half of a economic cycle. Usually when the economy overheats, commodity prices go up, and the commodity prices go up because there's usually something maybe there's an expansion of credit growth, or maybe there's excessive fiscal fiscal deficit spending that can actually lead to an acceleration in the economy, or potentially even a hotter than expected economy, which is exactly what we have been doing. In order for the Fed to counteract this anticipated like increase in inflation, what they usually do is that they raise rates, right? Or they hold rates higher just in an effort to slow down the economy. This isn't good for stocks. And the reason why this isn't good for stocks is it's not the first or second order. So it's not the first thought, it's not the second thought, it's the third thought. So there's like this concept of first, second, and third order thinking. And from like this perspective, when you think about the cycles, it's actually the third order line of thinking that can really lead us to assume like why stocks are going to start topping out right here, right? So number one, we know the economic data is bad, right? Because it's showing an inflationary, it's starting to show that there's a lot more inflation. Not only that, but the sectors like XLE and gold are starting to accelerate. So this is telling us that there's an overheating of the economy right now. So in response to that, this is the second order of thinking. So in response to that, we can expect that the Fed is either going to raise rates or they're actually going to hold rates higher for longer. So this is okay. Usually, if we think about the Fed being higher for longer, that's not always going to be a bad thing. And I'm going to try to multitask right here. But it's the third order line of thinking, and what a lot of people don't think about, because a lot of the tightening in financial conditions, it's not necessarily done directly by the Federal Reserve. What it's actually done is it's actually done by the bond market. So I'm trying to pull up the 10-year yield on TradingView, but for whatever reason, my computer's super hot, probably because I haven't ran it for a week and a half. I'll probably restart it after this. So I'm going to pull up the 10-year yield, and whenever this decides to load. So like there was something that I ended up realizing here in October. So October, so this September to October timeframe, this is the 10-year Treasury yield. This September to October timeframe, what I ended up realizing, I got to make sure that I'm sharing my screen. I learned from last time. The September to October timeframe, what ended up happening is that so I remember listening to a lot of earnings calls during this time, specifically like Global E, Walmart, and a lot of these consumer facing companies. And I noticed that a lot of them were seeing a lot of weakness in the overarching like macroeconomic data, meaning like the consumer, right? So they saw a lot of weakness in the consumer, and now Lululemon is also showing this too. So when we think about, I think exactly like what does a lot of this rising inflation mean? It's not necessarily going to be the short end, which the Federal Reserve controls. What it's actually going to be is it's going to be the long end of the yield curve, which does drastically impact the economy, that will start to go up if inflation data still continues to come out hotter than expected. And when the long end, this is called the bear steepening, when the long end of the yield curve actually starts to end up going up, this does send ripple effects through the economy, because the long end of the yield curve impacts not only, so it impacts the housing market here over in the U.S. It also impacts the vehicle market even further than what it's already being. And the vehicle market is absolutely in the pooper right now. Excuse my language, but it is. So you're seeing a lot of these interest rate sensitive sectors that are being affected by higher yields as is. If the 10-year yield goes even higher, we could certainly see further economic weakness, and that the 10-year yield will go higher in the event of more hawkish Fed speak. So if the Federal Reserve comes out and says, economic data is still too strong, or the jobs market is still too strong, or the CPI or the inflation data is still too hot, we're going to need to raise it higher for longer. But we can see right now that the federal funds rate right now, we know, is about 5.35 to 5.35. Oh, I know. Yeah, it's about 5.35 or 5.37, somewhere in that zone. So, but we can see that the 10-year yield is at about 4.42, roughly, approximately. If they actually end up coming out and they speak on a more hawkish tone, the 10-year yield will try to actually go up towards the federal funds rate, which will create further tightening in the economy. And this will directly impact the consumer, and it will directly impact both the commercial real estate market, even the consumer housing market, because now it's going to even put the housing market even more in a deadlock. It's the same things that are going to end up happening with the vehicle market or anything that's interest rate sensitive. So this week right here, when we look at the CPI data, is going to be a big deal. And I do believe that in the event that the Fed comes out and actually comes out more with a hawkish tone, and and the bond market starts to say, whoa, 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 10-year yield is a little too low right now from a structural perspective, from a long-term perspective. Maybe we need to sell more bonds, because I do think that the yields are going to start going up. And maybe they think that AI is going to make things different, or productivity is going to make things different, or maybe we're going to enter a more inflationary regime. This will send interest rates higher, and this will make the economy even weaker. So going back to exactly how this works, it's like, to rehash briefly, because I see that there's a couple new people joining in right now. To rehash briefly, what we're seeing is we're seeing XLE and we're seeing precious metals going up. So we're seeing the energy sector going up, and we're starting to see gold as an asset class go up. And this is usually historically going to be that late bull market behavior. So now what we're thinking to ourselves, like, and we can see that this is, so the yellow line right here is going to be the economic cycle. So now, in an effort to control that, to control what the Fed is likely going to be higher inflation for a longer period of time, the Federal Reserve can come up with a more hawkish tone, and this is going to be what's going to send us lower, like without a shadow of a doubt in my mind. And you can actually see this in the stock market too. So right now, what I ended up pulling here, so this is going to be the Nasdaq on a daily chart. So what I did is I made sure I pulled up both the daily and the weekly chart. So I'm going to make just a couple adjustments here. What I'm seeing is that I think that this is something to pay attention to. Is right now there's a negative divergence on both the RSI and on the MACD. So when we look at the RSI and the MACD, and this is completely irrelevant because we can even see, like, right here, when the RSI topped out and the MACD topped out, the stock market continued to trade higher. Not only that, but the leadership actually started to narrow into just a few choice names, specifically like Nvidia and its other parts that are exposed to Nvidia. So this is going to be the daily chart, and on the weekly chart, I thought that this is also going to be. I'm going to make sure I'm sharing my screen. I am sharing my screen. We're making progress, guys. All right. So, and on the weekly chart, I thought that this was very, very impactful right now. So, like, what we're seeing here is we're actually seeing this MACD starting to curl over, which is saying, like, we're no longer going to be in an uptrend. We're actually going to start being in a downtrend off of overbought conditions. So, like, right there, that MACD is telling me. So the last time that happened with the MACD, we can see right here, that was the beginning. So this is August, like the July-August timeframe. That was the beginning of the last correction that we ended up having. It was about a 10% to 11, 12% drop on the NASDAQ. Same thing ended up happening here in February of 2020 when that MACD curled over off of overbought conditions on the NASDAQ. And when we look at the S&P 500, it's exactly the same. So we can see right here, that at the moment, excuse me, guys. Sorry, sometimes I start talking so much and my mouth gets dry. That we're seeing that similar negative divergence going on here, but the stock market continued to trek higher. And not only that, but if you actually start zooming up into this range, so that previous uptrend, channel, it was like this, and then we ended up breaking that. So we broke the previous uptrend. I thought that was really, this is basically like a signal from the stock market saying, and that's called a bearish engulfing candle. I've seen a lot of technical analysis traders talk about that, or technical traders. Basically what this is signaling is that it could potentially be, I'm not necessarily 100% sure, but this could potentially be a topping out process in the stock market. And we're also seeing the same exact thing happening here on the weekly chart, on the weekly S&P 500. So not only are we starting to see this channel break down, but we are also seeing this, once again, MACD curling over, RSI overbought conditions. Last time this happened was going to be a little before the COVID-19 pandemic hit, so about that February timeframe, when we went from overbought and then the MACD curled over. Same thing ended up happening in January of 2018. So now what we're seeing that identical price action. So we can actually pull this up, and we can see that the MACD should probably curl over and come down in this area. So this is going to probably be what is likely to be this week or next week. So we could definitely see a lot of red end up coming into the markets. I could see us moving back into at least the 200-day moving average. So if we zoom up into the 200-day moving average, this is going to be what's likely. So we're about 5204, and this is 54631. So that's about a 400-point difference. That's going to be what's likely 600-point difference, right? No, 400, 600 points, 600 points. That's going to be about a 11 to 12% correction. So essentially what this is telling us is that this is telling us, right? So let's rehash because I'm seeing more and more people trickle in as I'm here. Let's recap. So number one, inflation data is going to be this week. Major catalyst. Super important to pay attention to, right? And the reason why this is important to pay attention to is jobs data came out hotter than expected, and jobs data has come out hotter than expected for the past 3 months. So in January, February, and now March, jobs data has been hotter than expected. And then CPI this coming week on Wednesday. Hopefully, we don't get a higher than expected read there too on both the core CPI and headline CPI front. Because if that ends up happening, I could certainly see, because the technical setup is there. The technical setup is there for some sort of stock market correction. And not only is the technical setup there, but the intermarket analysis that we're looking at is like what sectors end up peaking out the most at the late stage bull market cycle is going to be gold and it's going to be energy. And we're seeing that those are the two best performing asset classes so far this year on a year to date perspective. So, like, when we're looking at all of these signals and we start thinking to ourselves, like, what are we going to expect moving forward? What can we anticipate, especially for this quarter, specifically in quarter two? I do think that we are running a very high risk of some sort of stock market correction. But here's what's interesting. This is what's the interesting part. And I wanted to make sure that I was showing exactly like my full thesis and my full thinking here. So not only do I think that there's going to be some sort of stock market correction, I think that it's going to be maybe less so of a correction. This is okay. The best way to describe this is back in 2000 to 2002, there was a period of time where large caps substantially outperformed small and mid cap stocks. And the reason, and like that was obviously going to be the dot com bubble. What ended up happening as a response to that was that small and mid cap stocks outperformed the S&P 500 and the Nasdaq for the next few years. So at some point, and I ended up posting this on X, I think it was yesterday or today, earlier today. I do think that there's going to be a situation here where we see a lot of weakness in large cap stocks, but a lot of, so that just excluding, so this is going to be the Mag 7, right? I mean, right now the Mag 7 is trading at historically high valuations to a point to where it's actually pushing up the rest of the market. Because like if you do S&P 500 X Mag 7, it's probably trading at like a 17 forward PE, maybe a 16, somewhere in there. So it's really pushing up a lot of the asset, like the overall market. But when you see a lot of the small and mid cap stocks right now, they're actually trading at extremely reasonable valuations. So like they're for perspective, they're in line with like the 2016 bear market, or bear market, quote unquote. It wasn't a very big bear market, but it was, it was a bear market nonetheless. It was like 19 or 20% down. So you can actually see that the valuations are very reasonable in small and mid cap stocks, and a lot of this has to do with a lot of the higher interest rates. And it's not just that. It's not just the small and mid cap stocks, but it's actually a lot of the tech stocks that are out there. I pay attention to Jam and Ball's EV NTM revenue multiples, and the reason why I pay attention to this frequently is that this tells me what's going on in the hype stock sector, right? So if you guys know me, you guys know that I like a lot of the higher growth stocks. And there's one thing that's usually been really, and especially being a growth stock investor for as long as I have been, these are the assets, or the asset class, I should say, that is the most prone to bubble-like euphoric behavior. Usually, obviously, that happened in 2021 and even in 2018 for a period of time. And then even like it seems like every single cycle, my portfolio tops out at least about a month or two. And I'm going to show you guys this in a second. At least about a month or two before the market actually tops out. So high beta stocks, believe it or not, are actually a really solid leading indicator to what the market is going to do. They lead the market up and they lead the market down, and it's pretty on point every single time that I end up seeing this. So we can actually go to my portfolio and I'll show you exactly what I'm talking to you guys about. So let's go. I got to make sure I'm sharing my screen because we're making progress as a human being. So then we got S&P 500. So you guys can actually see that back at the last correction here. So like you can even look back at so I've been sharing my portfolio now for about a year and a half. So it's January of 2022 is when I started it. And you can actually see that when my portfolio peaked out, it peaked out about a week or two, or maybe about a month prior to the market actually dropping during that banking crisis. Same thing ended up happening here when my portfolio topped out in like the June, July timeframe. So it peaked out here, but the market kept going up for a period of time. And then eventually everything kind of went down along with it. And then once again, my portfolio led the market up. And then now what we're seeing is we're seeing a similar type of price action where my portfolio peaked out at the very beginning part of this year. And I knew that it was going to peak out because I looked at the valuations on a lot of my stocks. I'm like, this is ridiculous. Like these are trading at absurdly high valuations. But we've seen the market continue to go up. And it's not necessarily because I'm a terrible trader or because I'm a terrible investor. It's because of the stocks that I own. They're high beta stocks. And that's to be expected, especially when you're owning basically the same sector of stocks, is that they start trading in a certain, like, as a sector. So like periods of time when there's risk on, my stocks go up. When there's periods of time when there's risk off, my stocks go down. It's the nature of the cycle. But what I'm basically seeing here is that right now, high beta stocks and small and mid cap stocks and basically risk on assets are actually trading at really compressed valuations compared to a lot of the safer assets, aka large caps and indexes. And when I usually start seeing something like this tells me that the stock market is either starting to peak out right now. I think that it could be. I could be completely wrong. I could be another week or two out from being right. I don't know, but I mean that's essentially what I'm seeing, and this is what I've noticed. This is what I picked up on for the past few years is that I've seen these types of trends, and I think that when you actually apply that, like the macroeconomic data compared to the S&P 500 technicals, Nasdaq technicals, the intermarket analysis, and you start putting these pieces of the puzzle here together, I do think that right now is a very risky time to be jumping on into like energy stocks, especially, or a lot of the industrial stocks, or like consumer staples, or whatever it might end up being. And I do think that there's a lot of opportunity right now in the high beta stocks that I particularly own. So this is actually going to be on my Savvy Trader portfolio here, and I posted this for a lot of the group, or for the group that I got here. And I basically put like price targets on all the companies that I own, and this gives you what I wanted to do is just basically give like a general perspective of like what I'm seeing and how I see things. So I basically run valuations on every single company that I own, and I put them in with historical norms. And I use actually this right now I use finchat.io, and I use analyst estimates to completely take my bias out of it, because I know that sometimes I can be a little too excited about my companies. So I want to be completely unbiased, just use consensus sell side analyst estimates and say, what do I think could actually end up happening? And these are basically the prices that I'm seeing on a lot of the companies I own, specifically high beta stocks. Tesla has upside, Monday has upside, Datadog, the Trade Desk, Cloudflare, I see downside. Same with Palantir, I see downside. Sentinel One, I see upside. Snowflake, MongoDB, Mercado Libre is one of the best buys in the market. Global E, Shift4, dLocal, GitLab, and Navitas. So basically what I'm seeing here is I'm basically seeing that right now the market has been rotating for the better half of this year. It's been rotating into a lot of other value-oriented companies and a lot of risk-off sectors such as energy, industrials, and consumer staples. I do think that right now the market is looking directly at that CPI report. If that CPI report does come in hotter than expected, what I could see is I could definitely see a lot of selling next week. And I do think that the indexes are going to get hit relatively hard. I could potentially see the S&P 500 trading down to its 200-day moving average, most likely at some point at back half of Q2, early part of Q3. And I do think that that's going to be the likely trade here moving forward. Don't trade on that, but I do think that there's going to be a lot of opportunities coming up here in the markets. All right, that's all I got for you guys this week. Make sure to comment down on below. If you guys want to follow my Savvy Trader, feel free to follow my Savvy Trader. But until next week, we'll cover CPI and a lot of the other exciting data points that end up coming out. And if you guys missed the first part of the video, make sure you rewatch that. I talked about Tesla, the sectors, as well as the Fed rate expectations, and a lot of that macroeconomic data. Appreciate you guys. And until next week, of course, you stay classy.